Hello guys, welcome to our YouTube channel. In today's video, we will discuss how to trade the forex market without daily bias. While it's natural to have some level of bias, it's important to try and minimize it as much as possible in order to make unbiased and informed trading decision. So how can we do this? One way is to have a solid trading plan in place and stick to it. This can help to keep you focused and avoid making impulsive decisions based on emotions or external factors. In this video, we will be sharing more tips and strategies for trading the forex market without daily bias. We hope you will join us as we explore this important topic in great details. Thank you for watching. So as you know guys, every week has 5 days of trading. We're going to exclude Monday and we're going to show you Tuesday's trades, Wednesday and Thursday and Friday. So guys, all you need is to have a checklist. I'm going to put a checklist for you on the side of the screen so that you can follow what we're doing. Guys, don't worry if it is quick for you to understand the first two examples. I will show you in details. The last one I will talk a lot about how you can identify the levels, how you can have your the time zones we're going to take the trades. Everything I will talk in details the last one. So we start with Tuesday. So the first thing we do always is we are going to put the time zone. We're going to look for the time frame we're going to take the trade, the time window actually, and that is midnight New York and midday New York. The time between these two time frames is the one we are going to take the trade. In between them, the first thing you do is to identify your sell side liquidity and your buy side liquidity. So this is our sell side liquidity and it's our potential range that we will be taking our trades, and that means we don't need daily bias. That's our bias. The bias is automatically sell. We're going to sell to that range. And the second thing we are going to look for is we're going to mark our buy side liquidity, which is the high that was created before 7:30 in New York. That's our buy side. It's taken out of the market. So the third thing we are going to look for is market structure shift. Market structure shift is the third thing we're going to look for. Let me just label these ones. So the second thing is we're going to look for the market shift, which is around that line. That's our shift. As you can see, price is moving away from the shift, which means it's already we missed the first entry of the trade, but it's never too late for you. You can take advantage of it by entering from other fair value gaps. For example, here I found a fair value gap that price was reaching 2, so I sell from there, and you can take partials to the first structure that price is reaching for. For example, here you can take partials here, or you can just target the first the liquidity pool that we had on the higher time frames. You see, now we are tucked into a trade, so all you have to do is wait and see what happens with that trade. And thanks to gravity, price just dropped to the downside and reached to our first target. So guys, as you can see, price did not reach our target, our initial target, but price just stopped there because market was just getting tired and it was around New York lunchtime. That's why I had to take my profits and leave. This is where you being greedy is going to make you lose a lot of money. You have to put some factors into consideration. You see, for me, time was what made me get out of the train. That's why I jumped off the train, because the time I was taking this trade was not usually the time we always take the trades, and I knew if I had to stick with that, I will be getting involved in after lunch New York, and normally I don't like that time. This is our second example. I'm sorry guys, I did not record on trades that we took on Wednesday. I don't have Wednesday's trade, that's why I am showing you here, but it was a winning trade. I used the same strategy and it was a winning trade. On Thursday, when I came to the market, price was taking out an old low, so now my bias is automatically bullish. I go to the lower time frame so that I can have more structure, because you can see price was just a straight line, but now into the 15-minute you can see there is a structure in the market. So I have to mark my buy side liquidity that I will be targeting. So this is my buy side liquidity that I will be targeting, and that's where I will be taking my profits. So now we go to the lower time frames and see if we have the shift. You can see that's where the shift happened, so I had to pull out my buy position and buy from there, targeting the buy side liquidity we had. Normally I put my range, I measure the range so that I can know the range I have, and it's 40 pip. It's a good range. Trade played out. We are tucked into the trade now. I had to just wait and see how it plays out. Few moments later I came back and it was winning, moving very well, smooth. This is where lady greediness played its butt of the trade. You see, if I had to take a partial, that's a profit for me. It's 1-to-1 trade that I will be having, but I was greedy, expecting more than that, and what happened was that I left to the gym and I came back when it was a losing trade. You see, the same thing that we talked in the previous example happened. Now this is Friday. Friday is another day of the week that I don't like taking trades, but I had to include in this video because it worked on our way. So guys, I did not record before, but I came back later and I had to look for it. The first thing you do is you are going to measure the time zone that we normally take the trade, which is New York midnight open and New York midday. So these two time frames are the ones we are going to take the trades. In between these two is where you're going to execute the trade, and that's normally the time I come to the monitors. Guys, look this one closely, because here is where I'm going to explain things in details. I have my two vertical lines now, you can see, and the time in between them is where we are going to take the trades. So let me go to the lower time frames and see. Here I'm going to measure my liquidities that will be taken out, or my buy side liquidity and my sell side liquidity normally. And you see price take out recently a buy side liquidity, which means price will be reaching for the sell side liquidity. So I had to measure these two before I go to the lower time frames also. You see guys, price took out a high after New York midday. You see, that's our New York midday line. So price took out a high after New York midday, and you can see on the left side, you can see that is the high that was created in the time that we normally take the trades. So this is where normally Michael calls liquidity bull. Equal highs, relative equal highs. You see, price took out two equal highs and dropped to the downside, reaching the sell side liquidity that we normally take the trades from. So let me go to the lower time frame so that we can see things more clearly. So this is the price leg we are going to look for. You see, that is the high that was taken out before 7:30, at the high that was created before 7:30, and it was taken out. If you go to the left, price took out all these highs. So around here is where we are looking the market shift. So how can you know the shift? You just go to the lower time frames. You see, when I come to the lower time frames now, I see price leaving some fair value gaps behind, but we still need to see the shift. So if I zoom in, you can see we have the shift. That's where market shift to the downside. You see guys, there's a fair value gap here. If you take from the first fair value gap, which is why Michael says the lowest hanging fruit, which means the first fair value gap, you see. But normally I took my trades from the highest one, the one that is closest to the because that one gives you more of it gives you more of a risk, small risks. You can manage your trade, you can have a stop loss that is small, tight stop losses, and that's why normally I take the last the highest fair value gap, I can say that. But if you follow what ICT says and you take from the lowest hanging fruit, which means that one, you have a trade. For me it will be 1-to-1, that's why I don't take the trade. You see, this trade is I'm risking 1% of my account to make 1%. You see, that's why normally I don't take from the first fair value gap, the nearest fair value gap. I take trades from the, if there is only one fair value gap and I have to take the trade, I usually take. But if there is another one, I normally do this and wait until that one is reached. But you can see, and in this video, this trade did not reach the fair value gap that normally I take the trade from, but it reached to the fair value gap that Michael talks and Michael says you can take the trades from. So thank you guys for watching the video if you reached up to the end, and welcome to our channel. See you in our next video.